Hello and welcome to the SICTIC Investor Day. We start today with the investors training. We're a little bit late, 5 minutes, so I'm hurry up. We'll have just an information, very important information. We have that the event is recorded and will be published amongst the member only. So don't be afraid, we don't leak it to the press or somewhere else, and we don't make any Twitter content on it. So, but that's important, so whenever you ask question, be aware your voice will be recorded, not your face. So we have the investor training, our usual investor training. Happy to have somebody here who speaks really out of her experience. It's Tatiana, welcome. And we have about 30 minutes plus 50 minutes question. Is that okay for you?
Perfect.
So I give it over and you can present yourself right away. Thank you.
Okay, great.
This is the key.
Fantastic. So thank you, Ralph. And thank you for inviting me today, Thomas, Nina, Corinne, Florian, for inviting me to share my experiences with you all. And as you can see, today I'll be speaking about my experiences. I'll introduce myself quite briefly. So I've been working in the entrepreneurship ecosystem for about 10 years, and I've been on both sides of the table. So now, although I'm more on the investment side, I founded 2 startups, one of which, the first, which raised angel investment. It didn't succeed. And the second one, which also raised angel investment, and we exited after 16 months. And now I'm working for Ricolab. I'm leading their innovation lab and corporate venturing fund. And I thought I'd share some of the experiences that I wish somebody had told me when I first started out. When I first started out as an entrepreneur, in terms of what to expect from getting business angels on board. And also when I went to the other side of the table, because it's continuously a learning process and you never stop learning. So this should be a GIF, but as it's a PDF, it didn't work. And I thought I'd start this a little bit more interactive, a little bit more fun, and kind of give an impression of how startups see us here in the room. You know, we're here, we're throwing money, you're angel investors, you want to build a portfolio, throw the money at me. This is how we feel about 1 year into our first investment. So in this, Leonardo DiCaprio is actually throwing money into a bin. And at some point, we've all felt like this. And, well, I'm sure you all watch Shark Tank or Dragon's Den. You know, he's just made a successful investment to cash flow. And today, this is kind of what we're going to try and achieve, what I'm going to try and achieve, to share my experiences to cash flow. So here we go. The good, the bad, and the ugly truth are things that I wish somebody had told me so that I wouldn't have learned the hard way. So who here in the room is it their first time at a SICTIC event, or who hasn't done angel investment before? 1 person, 2 people, 3. Okay, so a couple of you. So welcome to the wild world of early stage investing. So why do we do what we do when it's high risk, high uncertainty? There's lots of uncertainty about return, although the potential gains are good. But it's the thrill, the enjoyment of being able to be around entrepreneurs, to learn from them, to see what new business ideas, business models, technologies are coming. The exposure that as an angel investor, you don't really get anywhere else. And of course, the potential to, somewhere along the way, hopefully, make some financial gains out of those potential bets. And some quite famous angel investors, I'm sure you know, Mayoshi Son, who was an angel investor in Alibaba Group when it just launched. Peter Thiel, like his politics, dislike him as a person, doesn't matter. He was an early angel investor in Facebook. And Okal, actually the first ever angel investor group I was off in Saudi Arabia, who invested in Karim, which is actually Uber's biggest rival and the second unicorn in the region. And it's probably at this stage that it would help actually me giving a little bit of background, because you're probably thinking, Saudi Arabia, how did this get into it? Well, I actually started off my career working, building the entrepreneurship ecosystem for the Saudi government. So I was barely 20, and I went to work for Aramco, building the first corporate entrepreneurship program there. And at the time, the startup ecosystem in Saudi Arabia was non-existent. What they saw as startups were actually SMEs or family businesses. And I spent close to 10 years there working for various government agencies, building entrepreneurship accelerators, industrial development programs, ecosystem infrastructure, worked a lot with investors, and then founded my own startup, which was in natural language processing. And we were the first to do semantic analytics for financial signals in Arabic, because it existed in English, it existed in lots of European languages, but when it came to Arabic, it really sucked. So took on this opportunity, and then I went to work for 500 startups and much more on the investment side of things. And I saw this ecosystem grow, and one of the first triggers to funding, to equity funding, was actually angel investors, because venture capital firms at the time didn't really exist. Even to this day, there's maybe 5 or 6 big firms who invest along Series A and B, but early stage funding, there was absolutely none. So it was prominent businessmen who would form groups and find talented entrepreneurs and invest in them. And this happened with Souk.com, which is the Amazon of the region, billion-dollar company. Karim, billion-dollar company, and a number of other ones who all started with Okal, and at the time were 5 or 6 people based in the eastern province, and now it is a global network. And now I'm back here in Switzerland because I wanted to come back to my own ecosystem and work with local entrepreneurs. So in the lessons that I learned, and I'm going to be sharing 12 of them, and that you know, and you've probably heard, it is 50% off investments fail, including my first one. Actually, with angel investing, you do increase the chances of a startup succeeding a little. If we look at data and statistics, about 25% of startups who've received angel investors actually have a higher chance of success. Also, 16% of them have more employees and grow a little bit faster. And 11% of them, compared to other startups who haven't received funding, actually go to exit. But the failure rates remain really, really high. Over 50% go out of business. And, well, we can see, for example, who's heard of the Siroup going down? Yeah. So it shows that even 2 big companies getting together to found a startup, it can still fail. And when you're investing at pre-seed or seed stage, this actually does heighten the risks. So how do we limit the potential for failure? And for me, it is really about portfolio diversification. It doesn't matter whether you invest 10,000 francs or 10 million francs. You want to build a very diversified portfolio. So for me, how this looks like is come in thinking like an investor. Even if this is a side hobby that you're doing, you still need to come in thinking like an investor. For how long do I want to invest? What is going to be the life cycle of what I'm investing? So let's say typically, ideally, there's no magic number. There's no magic bullet formula to the number of companies you should be looking at, but I would say across 4 to 5 years, ideally 15 to 20 companies. And what I've seen is you don't want to concentrate your investments. So we all like investing in our comfort zones, and it's very good to have a specialism, and I'll be speaking more about that later. But you don't want to be investing solely in startups who are the same business model, the same type of product, the same type of teams, because ultimately you're actually heightening the risk of failure. You want to be able to span it out a little bit. And of course, depending the size of your portfolio, at a certain point, it's going to reach a maturity within a couple of years. So let's say about 50% of the investments are going to fail, and you're going to continue investing. You're going to see a certain equilibrium where the failures, you can eradicate them, and the good ones will balance out the portfolio. And hopefully with this type of strategy, you can place quite a lot of small bets to be able to pick a winner. And at the end of the day, for me, it's mathematical. So it always comes down to maths. If you can understand the maths of how you're investing, you can hedge yourself a little bit more. So I was speaking about specialism, and that's something that we see a lot in the angel investor and as well as the venture capital community. So everybody has a certain thing in which they're very good at, be it a certain vertical, be it a certain type of skill set that you can bring. This is the added value that's relating whether you want to be passive or more active that you can potentially bring as an investor or as a startup. And for me, it is very important to focus on a specific vertical in which you have knowledge. It doesn't mean that you have to just stick to it and stay in a box. But having a focus area enables you to be able to grow more knowledge, to understand the types of business model and strategies that the startups who are actually succeeding are deploying. And it also makes you in the long run much more desirable to entrepreneurs. So if you're known as somebody who invests in the software space or the fintech space or the blockchain space, entrepreneurs at a certain point when they'll be looking for funding, where they're the very beginning of sourcing capital, they're going to be the person they come to. And this will give you access to better deal flow that then you can share with other potential investors. And it also, by using this, it helps you ask the right questions to the entrepreneurs you're working with, because you're able to parallel it with a certain expertise. And that specialization also has a lot to do with the type of stage you're investing with and how you're positioning yourself in the ecosystem. And this is a really, really important one, because as angel investors, a lot of people sometimes think, oh, are they very active? Are they part of the ecosystem? Are they as desirable as approaching a VC firm, etc.? I found here in Switzerland, and I've been back for about a year, that the angel capital really has been a catalyst to early stage financing and to actually bringing that trust to Swiss startups. And for me, it's created a lot of dynamism afterwards to be able to flow into venture capital and other types of equity funding. So the way that you position within yourself within the ecosystem, be it through a certain interest in specialization, but also be it through a certain stage of funding or even a certain amount, or whether entrepreneurs will know, okay, so is this a passive investor, which means he's going to be very hands-off, so he won't be very active operationally, or on the contrary, I'll actually be working with a very active early stage angel. They'll be operationally involved. You'll be able to manage expectations. You'll be better able to manage your portfolio to something which actually suits you and your time. You'll build a reputation and simultaneously have access to opportunities that you may otherwise not have. And especially when you're part of a syndicate like this at SICTIC, it then provides you the ability to then co-invest with other lead investors and have access to certain deals which maybe you wouldn't have had before. So the bad, because I've been speaking about a lot of good things, about what you should do, about all these good experiences, and this is lesson number one, bad, bad, bad. Don't overvalue your value. I have actually suffered from this. My first angel investor promised me a lot of things. I'm going to open you doors. I'm going to give you access to so-and-so. And I have this network, and you'll see you'll have this contract, and we can get you cash flow positive within 4 months. And in return, I was quite young. It was also my fault. You know what? Somebody that I knew very, very well in Saudi, who I had worked with in the past. I didn't do my due diligence sufficiently, because actually it's also an entrepreneur's job sometimes to do the due diligence to see if there's a good fit between the investor and the founding team. And well, he didn't do any of that, but he did take a big chunk of equity. So, and I'm seeing this, and I've seen it a lot with other startups. They need a quick infusion of cash. They think an angel investor is great. They'll provide me with the mentorship, a great set of skills and networks. And the angel investor kind of overvalues what he thinks he can give and says, you know, takes out a big chunk of equity, and then, I'm sorry for my language, screws over anybody else who wants to invest in the company. And the big lesson there is never overvalue what you can bring, and never forget that you're not going to be, hopefully, the first or the last investor. Because by doing this, you're basically just taking capital out of a company, and the 85% that you have actually could be 0. And as you can see, Nina, you're in the photo here, SICTIC. So, the good. We're very lucky to be here at SICTIC, because you have access to a great syndicate of talented and knowledgeable investors. And for some of you who are new here, there are a lot of attributes to going into angel investing and to actually co-investing with other more experienced investors. The primary reason for that, not all of us are accountants or lawyers or know the nitty-gritty of what it comes in structuring a deal and capital. I mean, even for myself, coming back to Switzerland quite recently, I know the laws inside out of how to do this in Saudi Arabia. I am still brushing up on exactly what are the most appropriate legal structures in Switzerland. So having access to this type of know-how is absolutely invaluable. Also, you can learn in terms of the diversification. So I was speaking about diversification and stepping out of your comfort zone. So you may not want to do that all by yourself. But if you can tap into the wisdom of the crowd, and this is something that we very frequently actually say to startups, what do your customers think? What do the crowd say? The customer is king. Well, it's kind of actually the same thing. If you can tap into the wisdom of the crowds of your fellow investors, you can actually start investing into the types of startups which initially you wouldn't feel as comfortable doing all by yourself. Because it doesn't necessarily mean that you have to be a lead, doesn't necessarily mean that you have to be very, very active, but you can trust into the knowledge and know-how. And as you start learning, etc., you can also adapt yourself, and you can also pivot. So frankly, I wish when I had first started out that something like this had existed, and then when I did join OCAL, it was an amazing learning experience. And this is a big one. I'm going to go more on some financial economics here. Full disclosure, by nature, I actually am an economist. So how does this look to everybody in the room? We've got a curve here, and we've got a market value of a company across its lifetime. Does that look attractive? Yeah, Ralph?
Yes, before you exit, right?
Okay. Does this look more attractive?
This is not true.
It's not true?
Never.
Never. Why not?
It's fake.
So this is kind of the economics that I like. It's not true, it's fake. I kind of believe that it can be true. And I'll tell you why. I think our role is to have this vision of potential future value, because as a very early stage investor, you have to try and estimate the value of a startup or of a technology before the market does. And it's actually even better if the market underestimates the value of this potential new niche, because that means that it will increase your estimated value. And basically, this is what we're doing in valuations. It's a lot of guesswork, but how can you look at a potential new startup who's entering a niche and try to evaluate in a premise which we don't really know very, very much about? So for me, there's three things, and this actually applies primarily to software and to ICT. And this is also something that I'm more comfortable with. How do you evaluate whether a company can go like this? So we've got customers, obviously. We've got average revenue per user, and we've got the profit margin. Well, when you're looking at a balance sheet, average revenue per user and profit margins are pretty inelastic. So you can get your valuation way off, and it doesn't matter because those won't really change over time. But customers will. So if you compare between a startup who is fast acquiring customers and another one who isn't, this is where the valuations potentially can really make a difference. And the major mistakes that you see, not only just early stage investors, I mean, they did it with Uber actually, is underestimating the value of a future niche market, because it's very, very complicated. How do you do that? It doesn't exist. Therefore, we're going to wait for it to reach peak point. Therefore, we're going to wait for the market to actually attribute a value to it. And yes, you can have a winning bet, but simultaneously, you may not get the value that you could have anticipated afterwards. And then there's a more complex one, which is trying to understand the value of a startup in a really fragmented market. And e-commerce was a great example at the time. There was lots of different players, quite small, but the market existed, but it was highly fragmented. So a lot of investors didn't want to touch it. And what happened? Giant came along, like Amazon, and basically cannibalized the market. And why am I talking about this? Because for me, when I look at a startup, and this is going to be so politically incorrect because I know we're in Switzerland and I know that 0 to 1 is a very unfavored book of most of my colleagues. But when I look at a startup, I think, can this be a potential monopoly? Can it potentially cannibalize a market? Can it create a market? Or can it create coherence in a fragmented market? And I love this quote by Adam McNamara because it kind of sums it up. So he was VP of Shopify, and now he's a partner at Remine Fund. And investing isn't about picking great companies, it's about picking companies that other investors have underestimated. And I think this is what makes our role so interesting and so difficult simultaneously. So that kind of moves on to how do you recognize potentially a long shot? And I'm not going to say a unicorn, but one of those shooting stars who can potentially create a whole new market or disrupt an existing one. So, of course, I mean, guys, you've been in the scene. So how do you recognize a winning business model or strategy? What do you look for in a startup? Okay.
Yes, the team.
The team is one, but in terms of a specific business model.
How can they really capture the market?
Can they capture it? Is it scalable? Is it capital efficient? And capital efficiency is something that even if you're not actively doing the financial due diligence and looking at the balance sheet, is very important. We're lucky in this industry, a lot of software and ICT startups are actually quite capital efficient by nature of the technology and business model. However, being able to identify whether a startup is capital efficient or whether how quickly they're going to burn through your cash, somebody else's cash, when are they going to have to raise the next round, can really provide you a good indication of whether it is scalable. And then another one of mine is, I think this one is vastly ignored, but it is the length of the sales cycle. And this typically really differentiates between B2B and B2C. On a B2C company, sales cycle can be 15 seconds. It's about triggering that emotion. With a B2B company, it can be months to actually close a sales. This impacts on pricing, this impacts on growth, it impacts on business model and so many other things. So a question that I like to ask entrepreneurs if they understand the duration and the length of their sales cycle and how much they're going to have to invest in sales to be able to hit some of their initial revenue numbers. And then going back to the kind of monopolistic structures, which I personally favor a little bit, is looking at the supply and demand side economics. Because we all talk about what is your value proposition, what is your competitive advantage. I like to see as what is your sustainable competitive advantage, because price and some other factors like this, a better customer experience, they're short-term competitive advantages. But if you can actually lock in terms of costs, where you have huge demand side advantages, or if you have IP as an intangible assets, or if the lock-in is much more difficult for actually somebody to substitute your product, these are sustainable competitive advantages. They're not created overnight, but if we can identify startups who have the potential and where the team understands that to build a sustainable business, for me, this is kind of a winner. And Ralph mentioned team, and I think this one actually deserves its own slide, because we can speak about business models, we can speak about valuations, we can speak about IP and technologies, but at the end of the day, and this is probably one of the most important lessons I learned, is it's about the people behind it. A business model, a technology, it can change. Actually, it will probably change at some point. What we're investing in today at pre-seed or seed stage is not where it's going to be in 2 years' time. But hopefully a team doesn't change, and it's that team which actually drives their mission forward and also your investment forward. So for me, a couple of things that I look for in a team, and there's no by the book. I guess you guys all also look exactly at the same thing, but it's adaptability. Are they flexible? Do they understand the space in which they're working in? Are they willing to learn also? You see it a lot in the technology space. Big techies, they know what they're talking about when it comes to technology. But sometimes when it comes to markets, business models, competitors, etc., they know a little bit less, but this willingness to learn and to understand that as a startup grows, as you grow in employees, as you start actually having responsibilities towards outside shareholders, that you need a little bit that willingness to learn and to adapt. And of course, leadership. I mean, leadership is a really big one, which we've seen in very large unicorns where they have a great business, but the leadership is bad and hasn't actually evolved as the company grows. And one of the things that I want to see, even if it's a 2 or 3 person team, is there's somebody there who ultimately can make a decision. Because if it's continuously a democratic process, at some point you're going to end up hitting a wall because nobody can make decisions and nobody can take ownership. And specifically at this stage, I want to also see entrepreneurs who can accept feedback, because you're not here to criticize. You're not here to say, I would do this, I would do that, but there is going to be feedback, which happens. And it's very, very telling, even during the pitch sessions, about how entrepreneurs react to the feedback that they're given. It shows a lot about their personality. And doesn't matter if you're a techie, doesn't matter if you're more into business development. Personally, I want to see somebody who has hustling skills, who will hustle one way or another, who is hungry and who will try and make things happen. Even when they bang their head into a wall, they're still going to try and make things happen, or they'll pivot and change. And for me, that shows a really, really good attitude towards being able to adapt to sometimes very negative circumstances, because, oh my God, they're going to happen. So, back to the financials, the unit economics. I know a lot of people who can't really actually properly read a startup balance sheet, and especially in this space. I mean, my internal belief is that the unit economics that we use today, such as CAC, ARPU, etc., were taken from Silicon Valley, Stanford dropouts who dropped out of their business class, couldn't actually remember what the terms were, and 10 years later we actually find ourselves with this. But seriously, the whole Silicon Valley swag in terms of the financials, it's important even if you're not involved on a day-to-day process to understand what they're talking about. What is the CAC? What is the churn? What is the retention? Because it's going to be able to help you to position yourself in an area where you understand where the startup is at, where potentially there's going to be bottlenecks, where the business is going, what are going to be potential future milestones, and better have knowledge of when you're communicating with the entrepreneurs in terms of financially what is happening. So this shouldn't just stay at the due diligence process. That should be an evolving thing, because especially in the software space, this is absolutely key. And finally, I've seen that a lot with angel investors. So normally I put them into two camps. The ones who think about exiting within 12 months and who think that you can get a return. And yes, I have met some. For my second startup, I had a proposal from a fairly well-known angel investor in Saudi who said, I'm going to invest $300,000 in your startup, but I want to start collecting my returns within the year. So there's this type of investor, or there's the other one who thinks, well, we're so down the bottom of the ladder when it comes to investing, I'm not even going to think about exit because this is going to be 5 to 7 years down the line. And probably one of the saddest things is that a lot of angel investors, at least that I've seen at some point, are actually forced exited. Because then the startup goes on to raise venture capital, has some other investors on board, and doesn't see as much the value of somebody who came in early stage. So it's very important from the onset to not only think about what are going to be my exit vehicles, because personally I don't believe you should ever enter an investment, however small it is, without thinking what is going to be the exit market. Could the company potentially be acquired? Is there a good fit with something else? And only 0.1% of companies actually go to IPO, so maybe not that far, but realistically think, what is the exit market? But simultaneously, how can I create value? Specifically, if I want to be a little bit more active, so that I can stay on board and plan my own exit at the right time. And for this is why I went back before to the unit economics, because having a solid knowledge of the cash flow, the balance sheet, and these types of things provides you a little bit of an edge and makes sure that you're also informed continuously of the process and any follow-on capital which is being distributed, to know when is going to be the right time for you to decide to exit if you want to exit. And finally, and by the way, I kind of sped this up because I thought I had 45 minutes and I actually only have 25 minutes.
We were 45 minutes, it's okay. We got 2 minutes.
Great. And I mentioned this really briefly. Great expectations. Does anybody want to guess what the last and probably one of the most important lessons is? I promise it's not some Charles Dickens-esque. So as I was speaking about my first investor, it was the over-promising. If you take me on board, I'll open doors for you, I'll give you my time, I will mentor you. And of course it all depends how active you want to be. Some of us are very passive, other ones of us actually like being to a certain extent operationally involved with a startup, or like mentoring. This is one of the great things about angel investors. You can be a little bit more hands-on. But be honest with the startups with which you work with, especially if you're starting to build a portfolio. It's easy to manage 1 or 2 startups. When you're looking at 5 or 10, and maybe on the side you have a day job or a business, your time becomes severely constrained. So consider how much time realistically you can dedicate to the entrepreneurs you're working with. Consider if you say that you're going to open doors for them, whether you actually want to do it or not. If you're going to do something, do it. Otherwise, don't. Let other people who maybe like being more actively involved in the mentoring and operational process do it, because otherwise you're going to have some entrepreneurs who are going to be bombarding you with emails, who are then going to be very upset with you and who won't understand why you were so hey-ho at the beginning and then you're just not available. And for me, I found that one of the most frustrating things, because I was one of those frustrated entrepreneurs who was bombarding with emails and phone calls and going, but we said we're going to do this and you said you're going to do that. And, you know, in my defense, when normally somebody tells me something, I believe it. And it's a lesson that I've learned now also as an investor, but also as a mentor, to not overpromise on your time, on the type of networks or connections that you can do, because otherwise people expect it. And that for me is a really, really, really important one, because it impacts your reputation. It's a small ecosystem in which we work in, whether here in Switzerland or all over the world. Ecosystems are quite small. And reputation and track record goes a very, very, very long way. So this is it. These were my learnings from the trenches of, you know, having come to Saudi and coming back here, and 10 years of working with startups and being with all you wonderful people. Thank you very much.
Very impressive, and I have to learn a lot of things again. Okay, I want to open up the round for 2 minutes, 3 minutes questions from interested angel investors. Are there questions? Yeah, Thomas?
Thanks for sharing, and it's great to see that you're still doing it, so it wasn't that frustrating after all. Now when you compare Saudi Arabia to Switzerland, I mean, you built up the ecosystem there. What are the missing parts in Switzerland that was also built up here?
I think what I'm seeing, I actually see quite a lot of similarities, believe it or not, between Saudi and Switzerland, specifically in terms of culture. So Saudi, by default, because of the business structures and the family structures, is actually much more entrepreneurial than we think, because the business composition and family businesses has made it naturally an entrepreneurial community. But like here, there is an aversion to risk, and specifically an aversion to failure. And when we see how Switzerland ranks, we're the world's top most innovative country, we have the most patents, and it's great. I'm seeing a lot of people want to start startups now, but the entrepreneurial mindset still needs to catch up a little bit. And then other similarities that I see here is actually the impact of angel investors. Here in Switzerland seems to follow a very similar trajectory than in Saudi Arabia, and actually in a lot of ecosystems. They're first individuals to kind of take the risk to do that. But then the challenges are also very different. Here we have innovation, we actually have IP. The startups in Saudi and the Gulf, to be fair, are very copycat startups, which has also its benefits, because if it's an Uber off or an Airbnb off, but which has been localized specifically for the market, first mover advantage is a very real thing over there. You don't need to be the best, you definitely don't need to have the best business model, but if you're the first on the market, because of the culture, it creates innate trust, which means that people will adopt your product, which has made it a little bit easier as an investor to be able to identify. If you couple it with a really good team, it's a little bit easier over there.
Okay, thank you. We have to stop here because of time reasons. There will be a lot of interesting questions, I'm sure. So
Thank
will
you,
be
Ralph.
here, Tatiana. Thank you very, very much. Up, I get your present.